Hello, this is Dale, and this is my nightly video blog for Tuesday, November 17th. Well, we did get out of the RUT today. You'll notice that when we got in, what we did is we sold the 1230, bought the 1240 December call, and we got $2.15 worth of credit. I had 220 on here earlier. I went back in my records. I only got 215. Today, when we got out, you could have gotten as low as 60 cents credit. I put down 65 cents debit here. When you go out, it's a debit. So it's the difference between the two, and that's $1.50, and that's what we're looking for is $1, and that's a 150% increase on that trade for this month. So we are out of that and doing very nicely. We're going to just stay into PepsiCo, we're going to stay into Verizon, and we're going to stay into our call on TLT. I do want to go ahead and exit on Nike tomorrow, and I'll show you why. We're at I think an extreme on Nike. We're up about 85%. We were up close to 100% earlier today. Gave some of that back, but I think it's a good time for us to exit that, and you'll see that that's our action for tomorrow. I'm going to go ahead and exit the Nike position, leaving just PepsiCo, Verizon, and TLT. Before I do that, I wanted to go over some theta math, and I wanted to do this last night when I was having some problems. And what I want to explain is a lot of times I'm going over certain percentages and I'm figuring how much money we're making on the trade and so on, and I just wanted to review this with everybody. First of all, the RUT spread between the selling and buying strike price is always 10 points. 10 points. So if in other words, we were selling at 1230 and buying a 1240 call December, and that's a 10-point spread. Now, 10-point spread times 100 shares per contract is $1,000 margin required by the broker per contract. For 10 contracts, then, it requires $10,000, and this is invested capital. And the reason why I focus on that is every night on the blog, what I'm doing is I'm trading from a $25,000 account. And with a $25,000 account for directional trades and for weekly trades, I'm putting on $1,000 per trade. So if it's up 100%, you've made $1,000. Well, on the theta, we've got $10,000 margin in that $25,000 account, and if you're up a dollar, like I'll show you later on, you've made $1,000. So the two kind of equate, and that's why I always talk about 10 contracts. Now, some people can't afford 10 contracts. Some people can only afford one contract, and that's fine. Some people can't even afford one contract, and they'd like to do this. You can use the IWM. The IWM is the ETF for the RUT. It's 1/10 the size. So let me continue then. On November 10th, we sold the RUT December 1230 call and bought the 1240 call for $2.15 worth of credit. Now, that credit doesn't go into your account automatically. That credit, it will go up and down as the market moves up and down. If it moves with us, in other words, this was a bear call, so if the market goes down, you're going to get a reduction in this premium every day plus the theta decay, and that's what you want to see. So if RUT trades below 1230 at expiration, you're going to receive $215 per contract, or $21.50 for 10 contracts. However, we're never going to take this trade to expiration. Our profit points are 10% to the plus side, or to the downside, a minus 6%. So for 10 contracts, we're looking at $1,000 or minus $600. This, you say, well, where did the 10 and the 6 come from? These points were established by myself after many years of trading. This is a great place to take profits. This is a great place to take losses. And what we're looking for is to generate income on a consistent basis. And if you follow these profit and loss points, you're going to bring in around 4 to 5% consistently month after month. Now, you're going to have some losers, but you're not going to have a large losing string, because this theta trade that we put on is a high probability trade, usually about 70 to 80% correct. So you're not going to have a string of losers, but you are going to have losers. That's just part of trading. All right, getting back to what we've got here. Today, the RUT credit spread could have been bought back for 65 cents. Now remember, some people got more or less than this. Some people got more or less than that. It all depends on what time you do it, what the market's doing at that given time, whether you wait to tomorrow to do it, and so on and so forth. I'm just giving you an example here. If you got $2.15 credit minus the 65 cents buyback today, that's $1.50, or $150 per contract, or $1,500 per 10 contracts. This $1,500 divided by the 10,000 margin required shows you that we made 15%, and that is over our profit target of 10 that we have established. So this was a great month. So at this point we pull out, and there are 30 days till expiration. That's a lot of risk for very little gain. We've got the lion's share. We took $1.50 out of that trade. There's only 65 cents left. Don't wait the 30 days till that expiration. You can use your money elsewhere. Take that out, take that profit, put it in the bank. Okay, let's just take a look at the RUT. And you can see that the RUT was actually heading up today, but then it pulled back as the market pulled back towards the end of the day. Earlier on, yesterday when the market closed, the RUT contract could have been bought back for 65 cents. Then the market opened today, and it was as high as getting it back at 80. Then towards the close, it was back down around 60. So that's how it's going to vary, depending on what time and what you're watching. Either short term, a 15-minute chart to exit. It all depends. So we are out of this trade. If we take a look at it, it's got 31 days till expiration. So that's we don't want to stick around for that. Let's take a look at our ETFs, and we are in TLT call. And I talked about last night that the possibility was that this was a pullback, and it was interesting because you can see we got in here on this measured move. We took it up. We could have taken profits here. This was about at the 127. It's pushing up to the 161, but it had a pullback. And you know that when it gets around this level on the Fibonacci, it's going to either consolidate or pull back. Well, it did pull back. Now, if we do a Fibonacci on this pullback, you can see, if we go to the low and then the lower high, that it came down to about the 161 and then reversed and headed back up. Actually made a measured move towards the end of trading today. Quite a rebound. We're going to hold on to TLT call, and we're just going to wait. Now, when I got in the first week in December, 118 call at 162, and it's currently sitting at 118 call, about 223. So this has been a very profitable trade, and that's why I'm waiting a little bit longer with this. It did make a move up, it did pull back, but I think we are headed a little bit higher. When we get up around this area, we might think about taking profit, because it definitely is going to pull back a little bit and consolidate for some time. Let's take a look at our directional trades. We are in Nike, and here's why I want to exit Nike at this point in time. You can see that this was the first measured move. We were in, and Nike has had a big drop, and it came all the way down to the 261 Fibonacci. When it comes down to the 261 Fibonacci, that's signaling that this move is overextended. It's a good time to take profits. So tomorrow, whether Nike is up or down, we want to go ahead and exit that very, very profitable trade. We want to stay into our PepsiCo trade, as PepsiCo moved up a little bit today but moved down, and the ribbon continues to go down. And the same thing is true with Verizon. The ribbon is still going down. So we're holding Verizon, we're holding PepsiCo puts, and we're holding a TLT short-term weekly call. I don't see anything else right now. I'm watching Microsoft for a potential entry into a put, but not right now, and we'll talk about that tomorrow night. Bye-bye now.